So let's talk about taxable income and tax liability and the different things that affect tax liability. There's several sections to this particular learning objective. We'll start with just talking about what goes into determining our tax liability and our taxable income. So this is kind of familiar. This is like that simplified tax formula, but it's a little different from the individual tax formula. This is our corporate tax formula. We're going to start, and again, this follows the 1120. This follows the format of the tax return. So we'll start with our total gross receipts or sales and subtract our cost of goods sold, just like we did before, to get to our gross profit. We are going to add in interest, dividends, capital gains, and other income. Guess what? Corporations do not have a special tax rate for qualified dividends. They do not have a special tax rate for long-term capital gains. They do not have a special tax rate for any of those items. It's one tax rate for every type of income. That's pretty simple, right? We didn't have to, that's a lot different from individuals. So as a result of that, we can throw all that in there. So we're going to add any interest, dividends, capital gains, other types of income to get to our total income. Then we're going to subtract all of our ordinary, necessary, and reasonable trade or business expenses. Same rules apply as to whether or not it's a deductible expense. Those rules that we talked about in Chapter 6, is it a deductible expense? Same rules apply. So it's not, we'll have 50% of meals will be deductible, not 100% of them. If it's illegal, kickbacks, bribes, that sort of thing, fee or fines, not deductible. So all those same rules that we already talked about in Chapter 6 still apply to those business expenses. Then we arrive at our taxable income before any special deductions. So these special deductions are what we're going to talk about in more detail here down below. If we have a net operating loss deduction, we will then subtract that. If we have dividends received or other type of special deduction, we will subtract that to arrive at our taxable income. So we're not talking about credits up here. So these are just deductions, things that affect our taxable income. Arrive at that, multiply it by our applicable tax rates, tax rate to singular, one tax rate, 21%, to arrive at our tax liability. Then we subtract any estimated payments that we made during the year. Corporations are required to make estimated payments. They don't have withholding, right? They don't, that doesn't exist for corporations. So they have to make estimated payments throughout the year, and any tax credits that they may qualify for to get to their tax due or refund if they had an overpayment. Most corporations that have an overpayment will apply the overpayment to the following year, so they'll just kind of keep that running tally. No AGI involved in this calculation here. So like I said, the determination of corporate taxable income follows the trade or business rules discussed earlier. There are a few differences. Those, like I said, the capital gains and losses. Charitable contributions have some special rules. Dividends received deduction only applies to corporations. And there are some other miscellaneous deductions. So here we go. We're going to talk about the differences now. So remember, for capital gains, for individuals, we were allowed to deduct capital losses, net capital losses, up to $3,000. And we could offset other ordinary income with those losses. For individuals, we do not have that for corporations. In fact, we don't even have a difference between long and short-term capital gains. There's no special tax rate, so we don't have any. We still net them, but it's just, do your losses exceed your gains? Do your gains exceed your losses? We don't have any of that ordering of the capital gains and losses, that netting. We don't have that headache with corporations. So corporations are not permitted to report any capital losses. So if we have a corporation that has a capital gain, and I guess it doesn't matter if it's long-term or short-term. That's not relevant. It's just capital gain or loss. I don't like that marker. So we have, let's say we have a capital gains of 3,000. All of our capital gains, long-term, short-term, in that bucket, capital gains. And then we have capital losses of 5,000. Well, this $2,000 excess loss, we cannot take that. We don't get to take that. And by the way, this is one of those areas as well where we have a book tax difference. We'll be talking about the book tax difference, because if let's just say for book purposes, these losses were the same, the gains and losses were the same, on our books, we would have a $2,000 expense, right? This would put us in the hole by $2,000, but for tax purposes, we cannot take that. What happens with that $2,000 is we can go back, is it 3 years? Let's see, offset capital gains. Yeah. So you go back up to 3 years, but again, that 2,000 is only going to offset capital gains in previous years. If you did not have any capital gains in any of those 3 previous years, then you can go forward. You can carry it forward for up to 5 years. If you continue to not have any capital gains that you can offset that $2,000 with, then it just goes away. It evaporates. So you carry back 3 years. So you can carry back 3 years. And then you can carry it forward 5 years. Like I said, if there's no point at which during that time span you have a capital gain, then you can't use it. It's just gone. This is different. So I had mentioned net operating losses. This is different from that. There's some different rules for the net operating losses that we're going to talk about a little bit further down here in this section. But this is just for capital losses. So let's take a look at what this would look like. ABC Company, these were their gains and losses, capital gains and losses. So 2020, 7,000 gain, 10,000 gain, 1,000 gain, 5,000 gain, and then they had a loss in 2024 of $21,000. They can go back 3 years with that loss. So what they would do, 1, 2, 3, they can't go back to 2020, that's too far back. That's 4 years back. They can take this $21,000 loss, and what they'll do is they'll amend their tax return. They'll change their tax return. They'll apply $10,000 of the loss, of this $21,000 loss, to offset that $10,000 gain. So they'll get some money back. If the tax rate in 2021 was 21%, so they're going to save $2,100, or they'll get a refund of $2,100 now when they amend that tax return. They've got $11,000 left, right? Of that $21,000, they've got $11,000 left. Let's see, that's no good. So essentially what we're doing is we're absorbing I don't even want to write on it because it's so hard to erase. So I won't write on it. So we're going to absorb $10,000 of that loss here. We're left with an $11,000 loss. Then we're going to go and we're going to amend the 2022 return to account for, we're going to absorb another $1,000 for 2022. So we'll amend that return as well. We'll get back another $210 because our tax rate was 21%, but now we're left with $10,000. So then we're going to go back to 2023, but we're going to start with the oldest year and move forward. Then we're going to go to 2023 and amend that return, and it's $5,000. That $5,000 gain, we're going to take $5,000 of that $10,000 remaining and absorb that $5,000 gain. So we'll get another refund for that. We are left with $5,000 of loss that we can carry forward. So if we have a gain in 25, 26, 27, 28, 29, those 5 years, we can then apply that $5,000 loss to any of those gains going forward. Does that make sense? All right. Let's take a look at this one. We've got Pirate Company, formed in 2019. They had capital gains and losses of this. So they had a loss in 2019 of $2,000. Obviously, they couldn't take that loss in 2019, but they have a $7,000 gain. They can't go back because they started in 2019. So there is no carryback in this example. But what they can do is they can take that $2,000 loss and apply it in 2020. So now instead of a $7,000 gain, they've got a $5,000 gain. So 2020, we're left with, let's see, so what do we have? 19, 20, 21, 22, 3, 24. So we've got a 2,000, 7,000, 10,000, 16,000 loss, 5,000, and $14,000 loss. Okay, so what they would do here is they would apply that 2,000 to 2020, and now we have a $5,000 gain. And then the next year they have a $10,000 gain. Then they get a $16,000 loss. So we can go back to here. We'll take that 5,000, apply it. So now we have no gain. And then we'll also apply 10,000 here. And we are left with $1,000 loss that we can then carry forward to this year. We'll apply it to that. So now we're left with a $4,000 gain. And then we had a $14,000 loss this year, so we can go back and take $4,000 of that. And we're left with a $10,000 loss that we can then carry forward. Does that make sense? So you start with the earliest, that 2,000. We can't go back with that, so we can only go forward. We're going to subtract that loss. We're going to offset the 7,000. Now we have a $5,000 gain. The next year we had a $10,000 gain. The next year we had a $16,000 loss. So we can go back with this $16,000 loss. We can apply 5,000 of it here. This is from 2022. This is from 2022. We're going to apply another 1,000. We're left with a $1,000 loss here. Then we can apply that 2022, the rest of that 2022 loss to the 5,000. We're left with 4,000. Then we had a loss in 2024, which we're going to apply back here. And then we have this $10,000 carry forward to future years. Okay, so that's how the capital gains and losses work. So as I mentioned here, so corporation will carry back a loss. When it carries it back, it files an amended return. Obviously, if you're carrying it forward, you don't need to amend that return, but you would indicate what year that loss, you're using that loss for. Tax rates, like I said, individuals will pay on the net capital gains, and it's lower than ordinary tax rates, and we've got long-term, and we've got short-term, and we've got collectibles, and we've got Section 1202 gains. We've got all these different tax rates, for these different types of gains, not for corporations, just 21%. Super easy there. Net capital gains are included in regular income taxed at the regular corporate tax rate. Questions about the capital gains and losses? Just remember, back 3, forward 5. Okay.